Welcome back, ladies and gentlemen. Thank you for joining us again this week. It is your friendly neighborhood PM, Clayton Allison, joined again by our Deputy CIO, Will McGough. And this week, we're talking about macroeconomic data and why it still matters despite all the headline news. So, without further ado, let's dive right in and get you started. So, Will, what's been going on lately? What have been the major data points that have come out this week? Despite all the headlines that are going on, why should we continue to focus on it?
Clayton, thanks for having me back on. We're down a few folks with Tara and Scott not here, so we'll do our best to entertain everybody that's watching. Headlines are moving markets. I think everybody knows that. And that's day to day, especially around tariffs and geopolitical tension. But it's May 1st today, and we just had a slew of economic numbers come out yesterday, which we call macro. And macro data still anchors the policy path of the Fed going forward. GDP, inflation, labor market are all readings that tell us where the Fed is going to go. Yesterday, which you probably heard on the news, Q1 GDP was negative, about 30 basis points. Once you strip out the volatile components like inventories and net exports, consumer domestic demand was strong, growing at 3% annualized pace. Also, consumer spending surged in March. And on top of that, real disposable income posted strong monthly gain year over year. So these are not recession signals, at least yet. But macro is just one piece of the equation. The other side is micro, which is stock bottoms up stock analysis. And as we all know, the Mag 7 has been driving the market. So Clayton, curious what you think of the Mag 7 and how earnings season is going overall.
Well, at least right now for earnings season for the Mag 7, it's been relatively positive. You've seen Microsoft, you've seen Amazon, and now you've seen Meta and Google all post relatively strong quarters, and you're seeing the market react in kind to that. Now, it has been mixed throughout the market because, once again, it's not just the Mag 7. Those are, like we all continue to talk about, the Mag 7 is just the top 7 names that have been driving the market. There's 493 others in the S&P 500. So while the Mag 7 has been performing strongly this past quarter, we have seen mixed results, especially across more retail and discretionary spending segments as such. So with that said, and before we kind of dive more into that and what their guidance looks like, I think it's important that we kind of peel back another layer when it comes to economic data and kind of how that's going to impact Fed policy decisions going forward. Because as the Fed moves, well, the market tends to move also. So, Will, could you give me some more clarity on that for our viewers?
Right, yeah. So we've obviously talked about things in hindsight. How does the data look today? And that's obviously reflective of how it's been historically. But as we all know, the markets are a forward-looking machine. And right now, most major market players are looking at rates. Rates are driving all the equation right now. The Fed is staying higher than the two-year Treasury yield, so the market is lower than the Fed, which is a signal that most likely rates will come down. The Fed typically is like a super tanker. Once they shift their direction, it takes a while for them to shift course. Outside of that, inflation is obviously very important. PCE, CPI, we saw those numbers are sticky, but they're not super high yet. So we're looking to see where the Fed may go, and a cut here could add a lot of fuel to this fire. But that's just on the macro front from looking forward. Curious what you're seeing with companies giving forward guidance, Clayton.
Yeah, I think, like you said, well, it's perfectly articulated. A lot of this data and a lot of the Fed decision making is backward looking. They're working with data that is kind of lagging behind what you and I would see on a day-to-day basis if we're going out and shopping. And just for everybody's kind of additional context, a lot of the stock market is viewed as a leading indicator. So as companies make decisions, that usually then trickles through into the economic data that Will was talking about. And right now, guidance has been very, very mixed going forward. You do have a lot of the Mag 7, like we've talked about, still giving strong guidance as a virtue of their strong cloud segments that they're building out, AI, CapEx infrastructure. But what we're starting to see is a lot of the day-to-day shopping that most consumers see, eating out for food, buying clothes, things of that nature. We are seeing a lot of companies actually cutting guidance or removing it entirely. I mean, you have entire airlines, Delta, Southwest, American, that have suspended their guidance entirely, given the uncertainty in the market right now that they don't feel that they can accurately forecast consumer travel demand. And then you have people like Starbucks and McDonald's who just missed on their earnings earlier today. And usually McDonald's is viewed as a bellwether. If the economy looks poor, you're going to end up shopping at McDonald's if you're going to go out to eat, because it's usually cheaper, they have good deals. But right now, you're even seeing consumers peel back from that. So that might give us a little bit of a sign going forward that consumers are starting to be a little bit more targeted with where they want to spend their money, and it's not going to be for all these discretionary purchases. And if that continues to follow through and companies peel off their spending or growth plans because of that, you could see an increase in unemployment, like we've seen tick ups recently. Also, potentially, a lot of these companies are worried about a reacceleration in their prices due to the new tariff policy. So, a lot of consumers are kind of speaking with their wallets right now of, well, I don't want to go shop if I'm going to see a price hike. I don't want to pay $8 for a coffee anymore. So, we're seeing weakness in certain areas of the market, but not widespread yet.
Right. Thanks, Clayton. And so just from listening to us talk, there's obviously a lot of consternation with where the market's going to go, which leads to volatility. And in volatile markets, the most important thing that I could recommend to investors is to have conversations with your financial advisor. It's a good time to look at your risk tolerance. Is the market causing you to want to make moves to your portfolio, specifically going to cash, which is typically one of the worst decisions investors can make. But if you think about these videos that we've put out and some of the communication we've had, we kind of knew it was going to be a volatile year coming into the year to begin with. Peak earnings growth, back-to-back 20% plus years, elevated multiples. You throw macro issues on top of that, and we're in a range. Washington, D.C. is typically dysfunctional, which Wall Street likes. But what we're seeing now is a Washington, D.C. that's having a lot of effect on Wall Street. And again, it's just more volatility. And when things are volatile, core up the portfolio, stay diversified, and stick to the financial plan. And if you don't have a financial advisor, reach out. We've got many across the country that would love to help you out. And with that, thanks for joining me.